How you doing, folks? Hope you're doing well. So we're going to be doing a rather brief review today, and we're starting with the dollar index. As I mentioned this morning, we did a live stream before the opening bell of the equity market, and I mentioned how this level here and this high here would be used as a draw. So it's not expected to be a straight run to it. So it's going to be probably a back and forth type thing to eventually reach up there. And I covered more or less what would change my mind about this market being bullish and all the other markets being bearish. So I won't revisit all that here. Going into the euro dollar. Okay, so we see how market reached below this level in here. I counseled you that we would likely see this in here as a draw if we got excited and animated below this low here, which was the initial draw on liquidity, which it delivered beautifully. And let's drop down into the 4 hour. Excuse me. So you can see how we consolidated around that old low of May 31st, 2023. Then we broke down, created a SIBI, which is a sell side imbalance, buy side inefficiency. And I'll measure that for you so you can get a feel for the okay, so 1.0609 and 1 pipette actually is the high. If you look right up here, upper left hand corner, looking at the high of this candle, comes in exactly at that same price. So that's perfect delivery. That's not harmonic, that's perfection. And we had a breakaway gap in here, and we dropped down into the sell side liquidity pool that we were looking for. On an hourly chart, okay, you see how market broke lower. This one here, I was watching it. I wanted to see it actually become an immediate rebalance, which would have been a trade right back to this candle's low. So we had a nice big down close candle here. The next one, if it would have traded up and touched that right there, that's like one of the strongest algorithmic signatures in price delivery, if you know where it's likely to go, which is this low and lower, right? So if it ever did that, that is like an immediate rebalance, whereas a fair value gap of mine is a deferred repricing and rebalancing later on. So a fair value gap can stay open for a number of days, months, weeks, years. But an immediate rebalance is signifying that the market is only coming back here just to tell you that it's going to be moving quickly in the direction that either the imbalance that's below or above the marketplace, or the sell side or buy side above or below, respectively, as the draw would be. 15-minute time frame. Okay, nice little drop in here. What time of day is this? Right there. 7 a.m. Always time is New York. I don't care where you live. Okay, so we have the sell side imbalance, buy side inefficiency. That's broken up over 2 candles on the 15-minute time frame. From this low of that candle and the high of that candle is what? Fair value gap. Trades into it, sells off, consolidates around the low we were looking for, then breaks through it and goes even lower. Institutional order flow entry drill, partial entry into an imbalance, not halfway. Halfway is consequent encroachment. If it just pokes above it a little bit, that's institutional order flow entry drill. Now, because we hit these targets here and it's midweek, we have a few days left in the week. We've covered a lot of ground over the last couple weeks in all assets, whether it be the dollar index, equities, Forex, bond market, gold. Like it's moved around a lot. So it would be reasonable for it to want to have some kind of a retracement. I'm not going to be touching anything tomorrow, and I want to more or less encourage my son to try to do nothing as well. And we'll see if there's any action for me on Friday. But the idea of reaching objectives like this, one of the things that I get questioned a lot is when it delivers to what I either call openly, or if I have something I've been watching in private and it finally delivers, what do we do next? Like if it's on Twitter, okay, or a comment section is open on a video or whatnot, the new trader or the impulsive, impatient trader or would-be trader student, they immediately want to ask me, now what? Now what's it going to do? So, and I often wonder if it's somebody just waiting for me to do it wrong so they can say, ha ha, forget the 999 times you just did it right. But though this time here, we get to talk about that. But if it's not that, and I think it's not so much that, I think it's a matter of knowing what to look for next for them. Is like a dopamine hit for them, okay? Because they probably watched me call something and they didn't trade it, they didn't use it, and then it delivered. So now they're thinking, okay, if he tells me the next one, I'm going to jump on that one. So I always, create a pause, and it used to drive my paid membership students nuts. They would want to know right away what's the next thing, and I would try to condition them to sit still, enjoy the fact that we just outlined the marketplace. We did what everybody else says can't be done. You can't time the market. You can't do any of these. All these things that no one's supposedly able to do. But here we are in our community, and not just in my community. Other people that know how to trade well, they can time the market. But I try to promote the idea of relaxing. Once you get a windfall analysis, pan out for you, and to the degree of hundreds of handles and hundreds of pips, like the last couple weeks has delivered, you want to sit still and just take that in. Let it stew on you a little bit. Okay, don't feel like you got to hurry up and jump out there and try to do something, or that you should know what it's going to do next. I'm not convinced that we've made the low, but I do think that a day or two of retracement is absolutely fine. It doesn't mean that the market's going to stop going lower. It doesn't mean that the market has made a bottom. I don't suggest that we've seen any reason to justify that at all. And there's nothing that's favorable going forward that's going to cause the stock market, equities, or anything else to feel like it's a warranted venture to go and start buying. Let's go up to the daily chart once more. We'll drop in the pound dollar. That's so pretty, isn't it? That's so nice. If you ain't screenshot your charts with all the annotations like we're showing here, I realize I'm still on 5-year reviews today. I'm just wanting you to take a look at that. It's beautiful. We were talking about all this throughout the entire run. All on the G2 for free. Pound dollar. All right, so we talked about this pair as well. Longer term. Like I said, I mentioned this morning on the live stream. This balanced price range, we had this. I believe that's a weekly imbalance. Let me double check. Yeah, there's your weekly imbalance that we were marking out this morning. And I said that I would like to see the remainder of that closed in, and it becomes really efficiently delivered all through here. Because if you look at what's being shown here on the weekly chart, I didn't mention this morning, so that's the only reason I'm adding it here. Careful not to add too much time in this. I don't want to be too long with you today, but the back and forth, up and down, that range, the next day, or next week rather, I'm sorry. The next week we have this much of movement back and forth, and then we leave this previous week's range right there, and we come back down. There's no necessity for it to come all the way down here. Why? It's taken sell side here, it's taken sell side over there, so we leave this previous week's range. So all of this back and forth until we get to this candle here and it closes, this is our only inefficiency. That's why I'm highlighting that. So since we traded down to the low of it, it's going to take a lot more to get through this because this is a balanced price range. And this is the lower portion that's efficiently delivered back and forth. Efficiently delivered meaning that it's multiple candles trading to and fro to a high level and a low level that's overlapping, meaning this candle here, its high and low is pretty much the same thing as the next one here. Now, by itself, it means absolutely nothing. But when we have a bias, if we're bullish and we leave that range, this candle doesn't leave it yet. This one does. And then the next candle here, we have an inefficiency. So this becomes a factor for future price delivery. What would it be drawing price to do? Pulling it down. Why? Because the candle here that creates that inefficiency from this candle's high and that candle's low, there's one singular candle that creates the body there. And that's what I'm highlighting, that little blue box. It took from March of this year all the way till now in September before it was repriced to it. What did it do? It provided the back and forth delivery and price action where it only went up here on this time frame. Efficiently delivered price is where the market's going to offer it on the downside. And that's what you're seeing here. Okay, so that's the whole element of redelivery. Not rebalanced yet. It's just been redelivered. All right, so now the daily chart. All right, so we've worked off of this inefficiency here, using it as resistance. It broke lower. I believe this was a weekly imbalance as well. And it broke lower, and we went down to basically the low of the imbalance on the weekly chart, which is the shaded area here. Because we're at the midpoint or equilibrium of this shaded area, which is a balanced price range, because it has traded back and forth and then it left it here, and now we're trading back into it. So it's going to take a whole lot for price to want to just come right through into the lower end here, where I ultimately have that opinion that before we close the end of the year, I think that we'll see pound dollar below that level there. That's what I'm subscribing to, and I covered pretty much what I felt was reasonable for reasons why I don't believe it's going to be the case if certain factors for each one of the markets, which I won't do again here, but it's in the live stream from this morning, where I would submit to myself that I was wrong. And until those factors were seen in price action, I'm going to hold to that bias that I think dollar's longer term bullish still, and all the other asset classes are weaker as a result. So basically, risk off is still in play. Risk off is everything going down while dollar goes up. All right, 4-hour chart on cable. You see the really nice delivery down into that weekly buy side balance, sell side inefficiency. The fair value gap from the weekly chart, that's the shaded area here. So it just kept delivering lower, 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 lower. Hourly chart, again, just a straight break lower, break lower, break lower. These types of moves, if you're not aware of the higher time frames, if you're completely oblivious to what's going on the weekly, the monthly, the weekly, and the daily, you can many times look at these tiny little potential swing lows and get all excited thinking, okay, it has to turn around now. And it just keeps going lower. Okay, it's got to turn around now. No. Oh, it's got to turn around now. No. It just keeps going lower, 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 lower. This is a sell program. Okay. That means every single time you see an up close candle, think of it as a resistance level. And until we start seeing up close candles broken with price movement going above them, order flow is bearish. You don't need a trend line. You don't need a moving average. You don't need any kind of retail tool to tell you that, until we get down to the lower end of that inefficiency I mentioned this morning. And we got just beyond it by a couple pips. So let's see what that level is there. I'm going to eyeball it. So 21.14 and the low, and basically less than a pip. So it's only small little variance from that, and the same thing here. And we pretty much stopped for the day, which is expected. These types of objectives or targets, once they're reached, and we're in the middle of the week, we're in the last week of September. We've already covered a lot of ground. The market's dropped a lot. So when you reach these really deep discount objectives and targets on the higher time frame, it's reasonable to anticipate consolidation and or retracements. Doesn't mean pick a bottom in a bear market. It doesn't mean pick a top in a bull market. It just means that it's reasonable to expect some measure of consolidation and or retracement. Now, couple that and contrast that rather with what we see in books. Like I've never had a book where it made it very clear for me to know when to anticipate a consolidation, when to anticipate a slowdown, but not a reversal to an existing trend. Um, they would always show you examples in hindsight, but there was really no logic behind it. And that was a source of me losing a lot of money when I was 20 years old. I kept wasting my time trying to pursue something that no one really had a firm grasp on or could educate through any medium, whether it was me buying courses or books. It wasn't there. And what I've tried to do in my own analysis, in my own, I guess, life's work, is to try to create a language where myself and my journaling, and hopefully, in the future when I was going to have children, those children would have something to learn from that was a lot more beneficial to them as a developing investor, trader, speculator, whatever, and give them some context as to what to do and how to time the marketplace. So everything I've created is a language. So it gives us rule-based ideas that allows you as a student to go in and build your own unique model. And the major core concepts that I've made available on the YouTube channel, you use those building blocks to put that together. And I've done several models in the recent years where you can see it's very simple. They're very simple approaches to taking a few things and applying it to a market systematically and trying to work within that, that pre-packaged view of I'm only interested in the price if it does this at this time of day. And if it doesn't look like it's obvious in one side going higher or lower, then I do nothing because that's low probability and only risk a very small amount of money. And if you do that consistently over time, it'll give you a baseline understanding what it is I'm teaching and how you should navigate the market yourself. And you'll grow an affinity for one of the PD arrays or a model, and you'll build on that over time. Doesn't mean it's the last thing and the only thing you'll ever do in terms of trading. You might, outgrow what it is I'm doing here and find your own unique approach to reading price action. And that's wonderful. I would love to hear about it. But in the beginning, you have to have some kind of, measuring stick to at least measure and track your progress. Otherwise, how do you know if you're improving? How do you know if you're improving or if just one bad day is the beginning of the end? If you consistently keep making the same mistakes and you're not learning from them and you're not journaling it, that's not progress. That's you're wasting time. But trying to do something, failing, logging that experience, that's not failure. That's you getting a collection of data. And you need that for your personal KPI, your personal statistics. Because everyone else's statistics, whether it be mine, well, you saw my son today. He's had 12 days of running up in Top Step. And today he went on tilt on lunch at work, trading from a phone, and his perfect track record of every single day winning finally caught up with him. And he panicked, and he had to try to pursue everything he could to try to fix it because he didn't want me to sit down with him and say, why'd you do that? And he reached for what I told him not to do, the 5 contracts that was allowed. So he hit his maximum loss. It doesn't mean he blew his account. It just means that he hit his maximum loss. So they stopped him from trading, which is great because he probably would have blew the whole thing if he would have kept going. So he put in a request for another payout. So that'll be $1,500 and some change that he's made in less than a month. 2 payouts in 1 month. And he had 12 winning days. But today, it finally hit him. For 18 years old, brand new, to me, that's great. And he made money. Most people fail at these combines. Most of them never really get a payout. He got 2 of them. So his statistics are unique to him. Many of you that have been watching on Twitter, you probably were thinking, wow, this is great. And others were thinking, this is impossible. No way, And now finally the reality hits. 100% is not obtainable. You can have it for a little while, but eventually it'll hit you. And by having a journal, you'll be able to look at where you did things right and when you did it incorrect and not beat yourself up. Don't more or less throw away the model or throw away the approach simply because you deviated from the rules and went on tilt. That means you broke the rules, you overtraded, you traded with more contracts or traded more times than you should have. All those things are removed, hopefully, by having a rule-based idea and a plan where once it gets to levels like this, okay, in other words, if you're a Forex trader, this is what I'm getting at basically. Whether you're a Forex trader or a futures trader or a bond trader or a crypto trader, whatever you're trading, once you get to a longer term discount array that you've been bearish and you reach that level, try to avoid the impulse to want to take new shorts down here. Even if it was the drop, and say the bottom falls out tonight or tomorrow and cable goes below 120. I'm not saying it is, but let's just say if it happened, in the beginning you have to be able to let that go and not think that you should have known that, because preparing yourself for times when you don't want to trade, when not to do something, it's more likely that this thing's going to come up and correct a little bit. Look how smooth these highs are over here. See, my eye goes to stuff like that. And it could go up to that, bump above here, and then break lower, have a smaller shift in market structure on the lower time frames, and then resume going lower. Or it could go even higher than that. Or it could just go sideways inside this little shaded area. Either way, the point is this. It's moved a lot. If you've made money, or if you haven't banked something here, you should. It doesn't mean close your entire position. It doesn't mean take new shorts on. That's what I'm really getting at. Because we're really, 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 oversold without saying it with the indicators, because we've moved a great deal and we're inside of a target that I've been calling for, and you now see it. 15-minute time frame. Okay, so even though it's back and forth in here, it's still delivered to the low end of that inefficiency. And then finally look at the reaction here. When we get to the indices, it's even better. Speaking of, let's go over to the weekly chart, ES. All right, and here is E-mini S&P. I appreciate all the thumbs up this morning. I was asking for that because it's an encouragement to me. It's free to do it, and it kind of like gives me a report card on whether you like what it is I'm sharing in the commentary. All right, so I mentioned the inefficiency here, which is the volume imbalance, and then reaching into higher time frame levels and reasons for why price should drop or go higher. We went lower. We went outside the boundaries. I believe, if I'm not mistaken, I think I changed this from the weekly to the daily. Yeah, I think I did. I think we were talking about that this morning. That's why it's not looking right here. We'll change it when we get back down to the daily chart here. But this is the inefficiency on the fair value gap, but including the volume imbalance. So it should look like that. And we went outside of that. See that? All of this price action in here is efficient until we get to here, meaning multiple candles have traded back and forth inside of a predetermined range. And I say predetermined not in a way that I probably shouldn't have said it that way. Think about it like this. I'm not trying to explain what a balanced price range is. Okay, between these two lines here, price has traveled down to this low, up to this high, and where do we spend the majority of the time? In the upper portion of this range. But back and forth, we've worked inside this range, and now we left it and created an imbalance right here. See that? So when and if we ever get back to this time or price, which we did this week here, it's going to take a very significant price run to dig down all through this range of price, because it's already went back and forth. There's nothing inefficient in here. That's what I'm getting at. Whereas we have an inefficiency here with the volume imbalance and the fair value gap. together combined. It's easy for price up here to truck down into that. I was in Top Steps live stream 2 days ago, and they were talking about what they were looking for, and I said I like this the 610 level on NASDAQ, and that was because S&P has already and had already shown its willingness to want to go down and get into this area. So a six sister theory, which is what I teach too, is because these markets are closely correlated, that means they usually move in tandem, not minute for minute, not every single day, not every single session. Sometimes there's a crack in that correlation, and that in itself is an insight that you can use. But for the perspective of looking at setups that have yet to form, one of the indices, just like one of the currencies, might make a fast run before you get a chance to get a hold of it. No problem. If the other correlated markets or pairs, if you're trading Forex, have yet to meet its respective objectives, and when we get into NASDAQ, I'll show you what I'm referring to specifically. But the S&P had been the laggard. That means it's been the weaker of the two. Remember, all through the beginning of the year, we were calling NASDAQ higher. It was the outperformer to the upside, and it was always delivering on the longs. When the market became bearish collectively, the S&P showed its weakness as the leader to the downside in terms of the speed at which it was reaching for its discount or raise, specifically these areas here. Okay, the inefficiency between that candle's low and this candle's high. And I mentioned whenever there's a volume imbalance there with a inefficiency, you always want to highlight that as well. So include that. Don't just leave it to like this. That's a classic, buy side imbalance, sell side inefficiency. But you have to compensate with this, because this is a volume imbalance in and of itself. So you have to make it like that, okay? As I mentioned this morning. I apologize, I'm kind of repeating myself, but I know there's some of you that are watching this and didn't watch this morning's. So we've seen some delivery, extend beyond the levels that I was looking for. And in this range in here, it's not able to get down through that. It's in the middle of the week, last week of September. We've covered a lot of ground, and this is a lot. 1, 2, 3, 4 weeks steady down on indices. Like they got hammered. I don't see that as capitulation. I don't see that as the bottom. I don't think we're done going down. Okay. But I just want you to think in terms of when do we slow and pump the brakes about taking new shorts? In instances like this, we're in a deep discount. It doesn't mean I wouldn't take a short if it was really set up. It just means that you don't want to take heavy shorts. Don't do maximum leverage. Don't try to marry the idea that you're absolutely right, because these are times where we can start seeing wicked intraday reversals where it's just running on short-term buy side just to acquire new shorting positions by smart money, and then another dump lower. We can get a lot of these reversals, but intraday. And then we're looking at a weekly chart. Let me drop down to a daily. We can start seeing a lot of these types of candles here where we have wicks and tails on both sides of it. It can do that a lot in here, all in this range here, because we are at a deep discount, and everybody is looking at the market that hasn't traded short. They're wanting to be short now. It's obvious to them that the market's been wanting to go down because it's already happened. That is the classic street money perspective. And that's why I'm trying to teach you as a student of me to look at the market in that way. From a sentiment standpoint, they like patterns. They like to be confirming something. They like to have confirmation that what they're expecting in terms of the market being bullish or bearish, it needs to be in the chart for them, or they won't trust it, because they don't know what it's going to do next, because they don't know where the market's likely to be drawn to, whether it be liquidity above or below the marketplace or an inefficiency. And I'll give you an example. Right now, we have an inefficiency here. I'm going to take this level off, but you should keep it on your chart, okay? But I'm going to take it off so that way you guys can follow me a little bit easier. You guys are spoiled today. Look at this. You got 2 live streams from me. I feel kind of guilty because my wife kept me from doing the video I wanted to do last night. So that's the teacher in me. So this is the premium inefficiency here, and the premium buy side is here. And I'll cover what that means in a second. Give me a moment. Actually, gonna miss me in November. Top. It's me, baby. I'm not a bottom. And then there is this inefficiency here. He did say that. All right, and then we'll change this to we'll do a blue hue. And I always do that with the text box. Here we go. Come on, old man. Do things the right way over here. All right, so we have this inefficiency here. And why am I even talking about this one? Like, what's the deal? Well, it didn't fully reprice to the low of it. Technically, we have what? We have that inefficiency. You mean to tell me that's something that you're worried about, ICT? No, I'm not worried about it. I'm not losing sleep. I'm just saying that if we make a move lower out of this range, okay, it's reasonable for it to want to reach down in this area here because it has not delivered the difference between this candle here on May 25th, the high of that candle, and the low of this candle. I'm skipping past this one because we've already dropped down to the right of this candle. The next day was here. It went down to that level, but it did not completely touch this candle's high. As a perfectly delivered, efficient market would be, it didn't do that. So what does that create? It creates the same thing we're seeing here, an inefficiency with buy side above it. This is a sell side liquidity with inefficiency below it. So you would have this. Oops, sorry. Okay, so now what I've already done is I've literally gave you the two either premium or discount levels that I'm interested in. So I'm not going to be with you on Twitter tomorrow. I'm not going to promise that I'll be on there on Friday. But going forward, if I don't talk to you on Twitter tomorrow at all, which is most likely going to be the case, if I don't talk to you on Friday, you should be looking at the market from this perspective here. Premium up here, discount down here. So if you're watching price and you anticipating things that are going to be continuation of the current theme here, which is bearishness, this is where we would want to see it draw to. Anything animated beyond that on the low end is the sell side down here, and I'll throw that on here for you. That to me, I think, is a little overzealous for this week. But hey, anything can happen, right? Anything can happen. But the market's going to go up to this or it's going to go down to that. And what you need to be doing is watching what price does at specific times of the day. That's what I teach my students. That's what my profitable students do. That's what I've been teaching my son to focus on. That's how I trade. I look for indications that the market's going to reach to one of these higher time frame levels. It's a draw on liquidity. Tomorrow, like say for instance, everything stops the way it is, and overnight we stay rather tight and doesn't move very much. And it stays really close to what we've seen in the body of this candle. Highly unlikely, but let's just play devil's advocate for a moment and suggest that that's the case. I would require 9:30 to 10 o'clock in the opening session or opening range of tomorrow's morning session, which I have no interest in trading because it's already done everything I wanted to do personally for this week. I can be wrong. I'm probably going to be wrong. So don't take what I'm about to say as the gospel. It could create another lower low. I don't suspect that it will if it does. It's only going to go down to this level here, and that would be sufficient for me if I was trading tomorrow. But I would want to see an opening range tomorrow, rally, run some short-term buy side. As I mentioned on Patrick Whelan's live stream, I was with him, visiting him and his members. And early stages of the day, I had no real bias that I wanted to work with. And then I mentioned how I wanted to see price run higher, take buy side, and then show displacement to the downside. And then I pointed out, sell side for liquidity. I'm sorry, liquidity for NASDAQ. And then you all know, as my students, where we have been looking for the longer term. And S&P and NASDAQ delivered like gangbusters today. So it's a matter of knowing what you're looking for at a higher time frame. So that way you don't take a trade on an intraday basis, whether it be a 1 minute chart or a couple second chart or a 5 minute chart or a 15-minute time frame. And as soon as you get a little bit of a move and you think, okay, that's it, I'm done. If that's how you're starting your progress and you're building up the courage to hold the trades a little bit longer, that's fine. But if you know that you can hold them longer because there's a model that suggests that it's going to go lower, and having these higher time frame, like this inefficiency here that was taught to you and shown you for weeks now, the tendency is for you to try to leave something on for these types of runs. And when you get them, even if it's 1 micro, okay, that very long protracted price run that you're a participant in, that is a huge confidence builder. And you want to have those in your trading because it teaches you patience. It teaches you how to not feel like I gotta win and I gotta take everything off right now because I can't stand it. If you feel that in your trading, and you're trading with multiple contracts, take everything off but one and just put your stop where you're going to make 200 bucks or whatever it is. You're going to make something and just leave it alone. Literally just leave it alone. If you're nervous watching it, just walk away. The stop's there. Put your target, your limit order at the higher time frame level plus a couple handles or maybe 5 pips if you're trading Forex. And just let it go. You've already banked it. You already took the lion's portion of the move out. If you don't do this, you will never develop the courage and patience to wait for these trades to pan out. And you hear these folks completely undermine themselves by complaining publicly in tweets, in videos, and live streams. It's so hard. Why is this so hard? Why can't I hold the trade? But why don't you listen? Why don't you listen to the things I'm suggesting to you? Because it's easy to do if you continuously desensitize yourself to it. In the beginning, it's going to be hard. It is very hard to hold for longer term targets. Very, very hard to do it. But if you don't gradually press into that discomfort and show yourself that, this isn't as bad as I thought it was. I mean, what's the worst that's going to happen? If you're in a trade, you're up, say you're up 50 handles in trading the indices or 50 pips in Forex, but you have an objective that says it still can move another 100 points or handles or pips. And you can afford to take off majority of it and leave one remaining contract or lot on the trade. And you move that remaining one to a profitable stop out if it does turn on you. To me, it's very frustrating that with I see a lot of folks that repeat this and they've been doing it all year long. And I've said this in tweets. I've said it in Twitter spaces where I'm talking live and giving trade psychology and insights and stuff. And I'm doing that here because I see live streamers that I literally follow and I watch. It's not just one, it's all of them. And they never hold on to these big runners because they feel like they can't hold the trade anymore. And I think the impact of being in public and being weighed in the balances by everyone watching, that has such a huge impact on their ability to be comfortable. It makes them uncomfortable. And when they have a win, they just simply want to take it all off. That's the same thing that you're feeling too in the privacy of your trading, where nobody's really watching you. But that pressure is so overwhelming that you just have to get out because it's so hard holding on to that win. Now, some of you that have never had a winning trade don't understand what that feels like. You're like, man, I wouldn't have that problem. I would hold it. No, you wouldn't. No, you wouldn't. The first stage of growing as a profitable trader is, first of all, staying break even. then working towards profitability on small little base hits. Then after you've built a foundation of doing that, you start stretching yourself just a little bit more. If you were doing 10 handles, okay, go for 15. You can do 15, okay, stretch for 20. You don't want to do what my son did today and reach for, okay, I'm going to reach for 5 contracts, which is extremely over leveraged, and try to do 40 handles. Wasn't ready for it. And then try to fix the mistakes because he had a 12-day perfect track record. That's what happens. I literally tweeted 2 days ago showing his equity curve saying, this is when you want to take a break. This is exactly when that inevitable loss is going to come. And when it does, it unravels you. And look what happened. It happened. So to avoid these things, you have to listen to the things I'm telling you to focus on. I promise you, the things that you're worrying about that are so uncomfortable, if you just simply do the things I'm suggesting to you, it'll help you overcome that fear of missing out, fear of, getting stopped out, fear of a losing trade. All those things are easily managed if you do the things I'm suggesting that you do. But one of the things that frustrates me as a trader, teacher, mentor, influencer online is I see other folks out there that constantly complain about how they can't hold on to these big wins when they can because they're holding multiple contracts. They're holding multiple contracts. And if you just simply just leave one on, and who cares? Who cares if it runs 50 more handles on it and then turns around and eventually stops out? That gave you more experience to hold on to it. You could have moved your stop loss and made a larger stop out profitable exit. But how are you going to grow? How are you going to progress if you don't press into these discomfortable, if you don't press into these uncomfortable positions where it's displeasing to you? You want to escape it. You have to find a way to be comfortable in your own skin while you're trading because this is the way it's done. And if you're constantly putting yourself in the highest form of stress, the highest form of leverage, placing so much weight on your results having to be Olympic level, you're doing what every professional money manager and trader doesn't do. I'm going to say that again. You're making this so likely to be impossible, but you don't see it. You don't see it happening because you want these astronomical returns, these unbelievable, unfathomable results where nobody can come close to that. And it's true. You can't even do it. But you're going to convince yourself every time you go out there that this is what you should try to do. And my son tried to do it again. Now, he hit maximum loss, so he has to start tomorrow recuperating from that. Can he do it? I believe he can. But can he listen? Can he listen to Dad? Can he listen to the rules? Today, he showed he wasn't able to. But for 12 days, he did. So that's progress. That's not failure. That's progress. So now he has to work towards, okay, can I do it now 13 days? That's his goal. His mindset is go forward, following the rules for 13 days because I could only do it 12 days. So now Dad's going to put his foot in my ass and say, okay, you got to do it one more day past that. And then he's in a new territory for learning. If you don't do those things in your trading, if you don't journal that, you're never going to be able to measure real progress. You're going to be spinning your wheels. And while you might have past experiences where you've profited, maybe you've taken profits out of the market, maybe you've taken payouts in these funded account companies, but at some point, you're going to have a real graduated increase in your understanding and your ability to do what it is you're doing, speculating in these markets. Give me a second here. My computer's on its last leg here. I'm going to plug it in. So anyway, this is what happens when you get a live stream from me. I'm going to go on all these 3-decade rabbit trails, but it's all good stuff. I mean, this is the stuff that you want to know. And if you don't think that you don't want to know it, then you're a fool because you're the one probably still working a job. And I don't mean to be ignorant, but you want to stop working, you want to build wealth, you want to start doing things as a speculator. These are things that you have to do. And the only way you learn how to do it or go to another level of knowledge is you have to press in. Press into that discomfort, press into that uncertainty, and do a little bit more of what you're not comfortable doing right now. And that's why it takes time. That's why nobody's going to learn this overnight. You're not going to walk out there. You're not going to be the Babe Ruth of trading, where you can point to the outfield where the ball's going to go when the guy pitches it and you just hit a grand slam. That's not how this works, folks. I mean, it's a lot of learning curve to it, and we're in very difficult markets. And I mentioned this before. I've been looking at these markets for over 30 years come November. Now, think about this. These markets are the most difficult that I've ever seen. Don't think that everybody that's been doing for a long time sees this as easy markets right now, because it's not. We have a lot of things looming constantly over top of us. Geopolitical, across the globe, there's things that maybe kick off that cause us potential harm. The economy, nothing good about it. They're not doing anything to increase it or improve it. All those factors are constantly coming at us and bombarding us. And it makes investors scared. And so the market's just going to try to churn and move all around. But it should be what? Confident building. Seeing the things I'm teaching you. Still, even in these climates, even in these environments, there's still a measure of precision that if you stop and think, okay, if I only do a handful of trades per week, well, I'm talking like three trades a week, and you really limit it down to the very best of the best setups, from a 4-hour and hourly chart, and when it does something in those time frames that leads to an objective that's rooted on something based on a weekly chart or a daily chart as a target or a draw on liquidity, your trading will improve light years. But in your mind, as a new student or a new trader, you think progress is every day making money, every day doing something with an execution where you're putting on risk. What you're doing is you're conditioning yourself to be a gambler, and you're conditioning yourself to be hopped up on risk all the time, never being comfortable in your skin, and trying to do something that nobody can sustain that. Nobody can sustain 100%. I can have a good run. My son, I'm trying to make him better than me. He might be better than me in the future. He may be out here teaching everybody the things that I don't want to teach you. But he's never going to get to that point until he does what he's asked to do that's uncomfortable. And he wants to get around it because it's unpleasant. He wants a shortcut. It's like, I want to trade for 50 handles. I want to go for those 100 handle moves, Dad. I think I got it. You don't have it. You don't have it yet, but you're working towards it. So I gotta, let me get back to this. I'll do a Twitter space this weekend. We'll finish off on this topic. But the idea is, when it's down in these deep discounts, try to avoid trying to take large risks on new positions, because we've already moved a lot. Reason why is because we're likely to retrace, because it's going to want to seek liquidity. Smart money will. Selling buy stocks being rated, that's being trailed. So when we get in these deep discount moves like this here, just think, okay, where are the short-term stops? And that's what I look for. That's exactly what I called out in Patrick Whelan's live stream this morning. I wanted to see buy stops hit, then displacement lower. And then, true to form, everything happened like we've been calling for weeks. 60-minute chart. Okay. Long process of working towards all this, and then finally moving lower outside the range of that inefficiency. And then let's go into a 15-minute time frame. All up close candles, once they're broken, they should act as resistance. 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 Down here, where are we at? Don't lose sight. Where are we at in this shaded area? We're at the low end of that inefficiency. So trading up to this level here to act as resistance, probably not going to happen. But it does go into this gap here, and then trades outside of the range, the shaded area. And then we have what? What's occurring? Swing high, broken, breaker, Watch that tonight. This right here, to me, I think this is just asking to come back up in that area. So on your charts, on your 15-minute time frame, you want to have this. Because this is exactly where everybody's trailed stop losses are sitting right above that. I'm not talking about retail risk stop. I'm talking about somebody that has real money in the marketplace. They have trailed their stops down here from all the way back here or something higher. This right here is where their stops are at. So if the market wants to go higher, what would it reach for? Is there any inefficiencies in here relative to where we are right now? No, there's nothing up here. So what would they be reaching for? If it's not inefficiencies above the marketplace, what is it? Buy stops. Where do buy stops reside? Above single highs or relative equal highs? So right in here, I'd be really interested in seeing what we do up at these levels here. And if they stay like this and we don't break this low overnight, I would expect this run here tomorrow morning. And I would look for a setup that either would allow me a run up into it, or if it does it, I'd like to see it break, shift in market structure, any fair value gap, I would short that. And then aim for whatever low forms prior to that relative equal high being swept. Is that complicated? I mean, really, let's be honest with one another. Is that complicated? It's not. It's really simple stuff. But the logic behind the things I teach in my concepts is I want to give you details because that's what I required. Maybe you don't need to know why every single candle should be formed a specific way. You just want to find a setup that you can identify. There's nothing wrong with that. There's absolutely not. You don't need to know everything that I know and that I'm willing to teach or everything on my YouTube channel. You don't need to know all that stuff. You just need to understand where's the likely draw on liquidity on the higher time frame. What's the weekly chart going to be reaching for? A higher level or a lower level? What is that level? Is it inefficiency or is it stops? Whichever one that is, you stick with that going forward into the week. And you just use every specific session and the market structure that would support that idea. And then choose your setups wisely. I gave you a silver bullet model between 10 o'clock in the morning and 11 o'clock in the morning, New York local time. That makes it so easy. So easy. You know when you're going to be trading. Before that, you didn't know what the hell you were doing. When does this stuff form? I don't know. ICT's got a million videos. What are we supposed to do all this stuff? I don't know. It's too complicated. Let's go get me a moving average crossover and stochastics. That's a cop-out. I mean, I literally made it really easy for you. You have a silver bullet at 2 o'clock to 3 o'clock. You have a silver bullet at 3 o'clock to 4 o'clock, New York local time. You have one at 3 o'clock in the morning to 4 o'clock in the morning, London session. If you really, really want it, you can do 7 o'clock in the morning to 8:30. Yep, just love tucking them in there real deep in the videos. The guys that don't want to stick around for it, they never get that stuff, do they? All right, let's go to the weekly chart and wrap this up with NASDAQ because Daddy's got stuff to do. All right, so here is the NASDAQ on the weekly chart. And my son was working with me today. He deleted all this stuff. I'm going to add it all back. I apologize. All right, and then this is the inefficiency I was telling you about, these relative equal lows. We would draw down to this. I don't believe we're done with NASDAQ, even though we've seen the S&P dig down into its respective inefficiency and then go below it. This is the six sister theory, okay? Because S&P has already done it, now here's a real big thing here. If you've always heard me refer to a SMT divergence, okay, SMT is a smart money technique or smart money tool. I've never settled in on what the T stands for, but it's just my way of reading cracks in correlation. Perfect example would be this. S&P has already traded down to its respective inefficiency, as we're seeing here for NASDAQ. NASDAQ just entered it today. What does that mean to me? I don't see that as an SMT divergence that's bullish. See, some of you are wrestling with that. What's the difference between Six Sister and SMT? And how do I not get fooled by SMT when the Six Sister is being employed? Well, that's experience, number one. experience is going to dictate that. And some of you don't want experience. You want overnight success on luck. You want lottery windfalls that had no real bearing on skill set. And I'm trying to teach you how to acquire real skill set through experience that takes time. So to answer your questions that come in my comment sections and or folks that send me tweets, I see that, but I have to wait for a time where it makes sense talking about it over the charts. I'm not going to just go out and make a video because you sent me tweets or questions in the comment section. I get too many of them. But the difference between SMT, which is like, for instance, because the NASDAQ did not go lower like the S&P did, normally, if I was bullish, that would be something I would be interested in going long on. But what is my bias? It's bearish. So I'm willing to submit to the idea that this is a temporary inability for NASDAQ to deliver on the same context that S&P submitted to earlier. In other words, lower prices are expected. S&P was quick to get to its targets faster. NASDAQ will just do it at a later time. I don't see this as, okay, what's going to go higher? That's S&T bullish divergence. An S&T bullish divergence would be S&P making a lower low, NASDAQ making a higher low, or reverse it. NASDAQ making a lower low and S&P making a higher high. I'm sorry, a higher low. That divergence between relative equal, or what would be not equal, but relative highs and lows, they should agree. If S&P makes a higher high, then NASDAQ should make a higher high. If NASDAQ makes a lower low, S&P should make a lower low. On an interim, short-term intraday basis, I can use that as a confirmation to something I already expect in price. So I use SMT in that regard as a one more confluence. I don't need SMT, but I like it to be in certain trades. I'm not demanding SMT to try to call the bottom in the S&P and the NASDAQ yet, because I'm believing that we still have weeks still, calendar-wise, of lower prices. There's absolutely nothing bullish about equities right now. And more people are going to be interested in selling short, which is why they allow these things to occur in the fall. It's engineered. You think, and you've heard, oh, it's selling pressure. People are getting out of their shorts, or I'm sorry, getting out of their longs and selling. No, the market's just repricing lower because they want you to sell. It's not going down because you are all collectively selling. They want you to sell. Why would the market be engineered to do that? Because they want to accumulate at lower prices, because they run funds. They run funds, they manage funds, and they want to get those stock prices lower so they can buy them up at a discount. That's the real world, folks. That's how these markets work. That's the industry. Okay. You can argue and talk about, but this guy wrote this about this in this book and he made it. I don't care about that. I don't care about all that stuff. Okay. That's nonsense. That's fiction. These markets are rigged. They're controlled. And if you submit to the idea that there's seasonal influences that take place in the marketplace, and nothing here technically suggests to me that we've made the low. I don't see it. So I'm going to stay with the idea that I believe that the NASDAQ will eventually dig into the deeper end of this shaded area and trade into this volume imbalance right there between this candle's opening and this candle's close. I believe that that's where we're going to trade to. And if we get overzealous and move lower, this area here. Okay. So let's drop into a daily chart. I like these short, brief videos. It's already an hour, ICT. What the hell are you doing, man? Relative equal lows right here. Let me take this off just for a second. We like them long, ICT. Keep it going, buddy. Keep it going. We brought Rhodes next. So we traded lower, hit it today here. And this inefficiency down here, I think we're going to dig into that. This level here, this is midpoint of that candle's tail, or the wick below the body. Half of that is consequent encouragement. I don't want to see it really go above these two candles here. I don't want to see that. It can, ultimately, it can do that. I mentioned this morning very specific things that I would be willing to submit to, and or what would cause me to no longer be bearish on NASDAQ. So I'll leave that for you to go look at that in that live stream. But I would have that consequent encroachment there noted in the bottom of this candle, which is the opening price right there. So 148.80, I'd have that as a key level. 4-hour chart. Look at that move right there. That's the relative equal lows on the daily chart over here. Now we're on a 4-hour chart. Look at the delivery of that. The bodies are just perfect. And then we ran up to here. Okay. In kind of like the similar fashion that I mentioned on the S&P, it's reasonable to see it want to revert back to some measure of buy side. So these highs in here look a little too clean for me. If it goes there, it might go above this. There's a little inefficiency right there. So that would clean up all the buy side here and go right into that area there. So I would have that on my charts overnight going into tomorrow morning. If we make a lower low tomorrow, just be careful because we could have a sharper retracement if we start to go against all this down draft in price tomorrow. Thursdays, generally, after we've met so many downside objectives and targets that we've been calling for months, it's likely that Thursday can create the low of the week. So you want to be careful. Okay, so don't try to, if we start seeing some really extrapolated retracements, if we make a lower low than what we have for today's low, don't fight that because it can go back into even up here and it would still be okay for longer term. Remember, we have lower objectives than where we're at right now. And smart money is greedy just like you. And they know that there are real orders up here. And they know that if they send it up in here, people are going to want to think that this is a low. And they'll be buying all that stuff. And they'll be selling into all that rally. And eventually, try to ride it into the coming weeks, going into November maybe, to see the lows that I think are later in the calendar year. All right, so 60-minute chart hourly. Okay, and a small little inefficiency right there. That's what we watched price go up into this morning. Right there, consequent encroachment, half of that. So it took buy side here by running up in the afternoon. This morning, it just touched the bottom end of it. See that right there at 9 o'clock? Almost gave an immediate rebalance right there too. You see that on this candle? Again, that's one of the strongest things you'll see in price action. If it can do it immediately once it creates a big candle upward, a big candle down, no matter what time frame. If you have a bias, it's bullish or bearish. When you see that, that's like saying it's time to get in right now. And your stop losses can be really, really short and tight. And then they have immediate snappy response where it delivers and runs right towards where you want to see it go to in direction. It's just a real fun thing to practice, which is a wonderful thing to do with 1-minute charts, 30-second charts, 15-second charts. Those things repeat so many times in the day, immediate rebalances. Those things are wonderful to practice. It's not about how many handles you make or how many pips you make. It's practicing. When it happens, okay, train your eye. Does it move immediately after doing that as you would expect? And when you do that, you completely desensitize yourself from the fear that you think selling short when the market's going up. A lot of you don't want to do that. It's scary to do that. Well, when you're trading a fair value gap, you're doing that very thing. And most of you, and my son was guilty of this and still is, sometimes he's afraid if it's a real fast run up into it and he's bearish or is expecting lower prices. I told him in the morning, this is where I think the market's going to go to today. That's what I do. Just like I do it on Twitter for all of you. That's not me trading his account. That's me saying, son, focus here. And then whenever you get a fair value gap, something that lines up after a stop hunt, then go in and do what you're looking for. That's not complicated. But you have to have patience to wait for that type of stuff. And also, you have to have a little bit of balls, basically, to go short as the market's going up. And fair value gap entries, institutional order flow entries, fading old highs or old lows, that skill set requires you to just trust that you believe it's going to go to a direction that's opposing the current delivery of price. That means if you're bearish, you're looking to enter when price is going up into areas where it's inefficient or taking out stops. What kind of stops? Buy stops. And you practice that intraday. You literally tape read. That means you're not even pushing the button. Not a demo, not your combine, not your funded account, not your live account. You're just simply watching it and saying, okay, it just traded into an area where I would be pressing a button right now. I'm not doing it, but now let's see what I see in price. And you desensitize yourself to that by watching it real time. That's tape reading. It ain't about looking at level 2 data that can be spoofed. Okay, it's not the DOM, it's not ladders, it's none of that stuff. It's simply just looking at price, how it delivers at a specific time of day for either inefficiencies or liquidity pools above or below the marketplace. That's it. That's all price is doing. That's it. That's all it ever does. No patterns, no nothing. It's just that. 15-minute time frame. All right, look at all this back and forth in here. And then finally it got real heavy here. Broke lower. Fair value gap. Breaks down, clears the level that we were looking for. Once it got down below it, look at the reaction. Is that random? You knew about this level down here for a month and a half. We've been talking about it as a draw. We've been looking for reasons to anticipate the market wanting to get down to this level. We got down to it here, and a lot of traders banked at that level and just below it. This rally here is not as a result of them covering shorts. That's what they'll tell you. They'll tell you this is a short covering rally. It's a squeeze because shorts are covering. I used to talk like that in my 20s because that's what the books and everybody on social media, on the forum message boards, that's what I was on AOL. That's what everyone tells you. So if you hang around that herd mentality, you'll talk like them too. You hang around cows, you'll moo. If you hang around pigs, you'll oink. Okay, so you don't want to be around people that talk like that because it's going to keep you from seeing how the market really books price, which is absolutely 100% rigged. It's rigged. It's an algorithm. It runs like a video game that's coded. It's already predetermined. The highs and lows are already predetermined. Oh, that's bullshit. It's the way it is. I couldn't call these things before I do it publicly and then be this consistent if it wasn't rigged. Nobody could be this lucky, right? I mean, think about it. Nobody can be that lucky, that precise. And it's because I understand what's going on behind these candles at the time of day, the day of the week, that week of the month, that month of the year, that season of the year, and how all these things relate to one another. And I'm waiting for these choice opportunities where everything is one-sided. When I have everything one-sided and I can see what it's going to likely reach for, that's when I tweet. That's when I go into other people's live streams and I tell them what's going to happen. And it happens. That's not bragging. I'm just telling you that these are things that people have learned from me and they do it on their own. And they're making real money, lots of money. I have students that are losing money and they're trying very hard to get out of that. Like anything else, this is going to take a lot of effort and a lot of time. I'll drop down to a 5-minute chart here. All the way back up into that inefficiency, taking out the buy side there. This morning was really nice. That was so good. And then this is the target, the liquidity at it. It's not support resistance, folks. Okay, support resistance would say, okay, it got down here, buy it. No, we want to get to it and through it. The way I teach my students is we have a level, we have an inefficiency. We want to drive into that like a bulldozer and just plow right on through it. Because it's not the level that's important, it's the liquidity beyond it. That's what we're targeting. It's not support resistance. That's garbage. That stuff is that's a loser's mindset. Knowing why a level should be traded to and through it is the beginning of understanding why the market's going to have these ups and downs each day, each session, every 15 minutes. It's running for liquidity. That's the lifeblood of these marketplaces. And the sooner you realize that, the more opportunities are laid in your lap. Because you're looking for patterns for the sake of patterns only. You're looking for some kind of an indicator to tell you to get into a trend that you have believed in because of moving averages pointing a specific way, or a MACD pointing a specific way, and a histogram saying that it should go higher. You're placing all of your faith in a religious capacity in something other than these simple little open, high, low, and close candlesticks, when that's what tells you everything. So I think there's one more I want to take a look at. I'll look at gold and I'm going to close it. Don't get used to this because I don't like gold. What am I missing here? All right, and let's go to a daily chart. And we talked about how I wanted to see it trade down into the lower portion of this inefficiency this morning, the sell side below here, and then we just about got there. Almost. So I failed there, right? ICT, you failed. Everything else we're not going to pay attention to, but this, you didn't get it right there. Okay. But like I said, this market here is very fickle. It's an event-driven market, meaning that it's, in my opinion, and I'm completely comfortable with everyone else not agreeing with this, but I think this is a market that should be traded less frequently than it is by most people in retail, because it's highly manipulated. It's extremely manipulated. It's like the Swiss franc. It's like the Japanese yen. I don't like those markets. You know, I've been burned by them. They're highly manipulated by their central banks, and gold is absolutely artificial. Gold should not even be below $25,000. Okay, it should be so expensive right now because there's none of it. You can't get your hands on it. Every central bank has been hoarding it the last 2.5 years, three years, and they're using it to back all the future currencies that they're going to replace everything that's in existence right now, and that's including Bitcoin and everything else that you know as crypto. So anyway, I'm going to close it here. Wish you all a very pleasant evening. I had fun today doing the live streams and this one here too. I don't want to make a promise that I'll be with you on Friday, but I won't be with you on Twitter prior to Friday morning. That I can promise you. So enjoy your Thursday. Be careful, be safe, study. Don't risk too much. Don't force your setups. Until I talk to you next time, be safe.